Week 12.
Week 12. Next week is the last week for lecture. Then the week after that, after week 14 is just tutorial. Because ada 2 minggu lagi.
Hello everyone. I think my student less than 30. Yeah, less than 30. Okay, wait, oh yeah, my times. But I think I already shown you guys that thing, the one that I already uploaded the topics coverage for your final exam. And even though without that, I also have verbally informed you guys last week what are the topics that will be tested for final exam. Wait, let me show first. I need to announce it again. Finance. Wait, I change to student mode first. Okay. Now, week 14, okay, we scroll down. Now, this week is week 12. So, today, I will lecture about this stock valuation. Okay. There are many calculations, and it's interrelated, okay, in this particular question. And then, next week will be the last topic, cost of capital. Okay. So, our lecture, next week will be the last lecture. But tutorial will be as usual. Okay. So week 14, we have the tutorial as usual to cover this topic. Okay. But then during the lecture 4 to 6, there is no lecture. Okay. And I will have open consultation session on week 14 Friday. Okay. This one on week 14 Friday. What else? Okay. So then, this one first. Our exam, 1st December, the first paper, right? My paper is the first paper, 2 to 4. 2 hours for the final exam. And our exam at Grand Hall. And don't forget to come early because we have to do the facial scanning. Yeah. But even though we have the, I will be there. I will be outside the hall. Together with the exam unit at that device, okay, because to stand by for the verification in case there's an error okay. But actually for the facial scanning, they will update automatically the attendance system together with our system But then they said this is just testing, okay. Still for the attendance we will do as usual. So don't forget to bring your student ID and then IC or passport, okay? Not only for my module, others as well. But if let's say your lecturer is there, then you forget to bring either this passport or IC, your lecturer can verify you okay? Okay, now and don't forget the hurdle rate thingy, yeah, you have to pass the final exam paper, okay? But then roughly, right, by right you should pass pass meaning 50% lah, right? Okay, but there's a capping lah. At least you should score 40% of the paper, but however subject to your coursework marks as well lah. Okay. Okay, now my question, I have 5 questions, all structured question like in your tutorial. Okay, and the theory one is the short answer one lah. There's no like an essay type of question for the theory, no. Okay, so the theory part already mentioned which part that you need to focus to. So please refer to that lah. If you say you're unsure, you can refer to my recording. Okay, and I also already rename all the files for the part note to recording here. So basically you can refer to the last 5 recordings here lah. Okay, you can refer to the last 5 here. Wait. Okay, now I have 5 questions coming from these 5 topics. Okay, so each one of these they have the sub question lah, amounting 20 marks. So 20 times 5, the total papers is 100% lah. Okay, and then from 100% I will scale down to 40%. Okay, because final exam is 40, and then your coursework, group assignment 35, midterm 25. Okay, so 60 lah, 35 plus 25, right? Okay. And for the marks for the group assignment, hopefully next week I manage to complete everything. Okay, if I did not manage to mark by next week, then it will be the last day, which is the week 14 lah. Okay, but I will update you guys. I have to complete it next week because I have my accounting students submitting the assignment today. Okay, so all topics they have calculation and theory, right? And then except for the cost of capital. Cost of capital purely 100% calculation. What's wrong with this projector? Where's the remote? Remote here. I just put it here. Okay. So, and then I would like to remind you guys, don't ever try to bring notes or try to cheat or refer to your phone. Please don't. All of us, the lecturers is very expert in cutting student. So please lah, don't waste your time. If you don't know, then that's it, you don't know. Okay? But don't try. Don't risk, because somewhere you're at Grand Hall, there will be like 10 to 12 lecturers. Okay, so please don't. And for your information, like Dr. Rabiah one, right? She always caught student every semester without fail. I caught students once. Okay, so please don't. Yeah, don't waste your time. It's not only for my module, also for others lah. Okay, and once you caught, right, it will be in your record. They will send the letters to the parents. Then if let's say you repeat that for I think 2 times or 3 times, they will expel you. Okay, that is in the student booklet. So please do not risk yourself. Okay. And then at the Grand Hall, I think last time Grand Hall the toilet is in renovation, but I'm not sure lah later on. December, right? Last time it's still renovation. What else I want to remind you about exam? Oh, and then exam, you'll be given 3 things. Question booklet. You can write on the question booklet. Okay, you can doodle, you can. Because we will dispose the question paper. And then, but the thing that you cannot write is this one, formula booklet. Because that one we reuse, it's reusable, recycle. Yeah. And then question, the answer booklet lah, yeah. So this one, when you do your revision, okay, please make sure refer to this formula. Get familiar with the formula. Okay, this is like this is for the bond. Okay, but not all formula you will use. Only selected, right? Because we have only 5 topics. Okay, so today's one, stock valuation, we'll be using all this, and then this one no lah. This is this one task 3 of your assignment. This is for the last topic. Okay. Okay, I think that's it for the final exam. And don't forget to do this extra practice question, because I think for the bond one, the question is insufficient, so I provided extra. But others like risk and return, part 1, part 2, and also stock valuation is sufficient. You just go through again the tutorial question. Okay? Okay, now, without further ado, today's one, stock valuation. So this is one of my favorite topic. This is one of my favorite topic. Okay, stock valuation. Okay, so here you will be looking at how you value the stock itself. Okay, there are many methods. There are many methods. But before that, okay, you have to know types of stocks. Okay, what are differences between common stocks and preferred stocks? Okay, and then you also need to know type of markets for the stocks and also the dividend policy. Okay, now differences between debt and equity. Okay, debt meaning borrowing, meaning liability. I was like confused. Who are these students? I don't wear my glasses. Like, who are all of this? And then, oh, okay. Okay. Okay, stocks, also known as equity, also known as shares. Okay. Okay, debt meaning liabilities, meaning borrowing. Okay. If let's say you guys can see here, then you look there. I don't know what's wrong with the projector. This one you must memorize, maybe like 3 points out of this. Can I? So now the differences. Okay, before this, last week we learned about bond, right? The debt. Okay, now when I issue bond, let's say I need funding, so I issue bond. Okay, so you guys buy the bond and then I have the money, then we proceed. Okay, bond is based on the debt financing concept, debt borrowing concept. I borrow your money, okay? And because of that concept, right? And you don't own the company. When you buy my bond, you don't own my company. That's what you mean by not an ownership interest. Okay? Look at that screen lah. Okay. So that is the first part, yeah? And then because you don't own my company, right? You also do not have any voting rights. Okay, you don't have any voting right. If let's say in terms of selection of the CFO, CEO, COO, you don't have the rights at all. Okay, basically you just lend me your money. That's it. Okay, and I pay you the interest and so the par value 1,000 lah. Okay. Now, meanwhile, for the equity or stocks, right? Okay, so when you buy the company share, you own the company. Let's say you purchase one lot, 100 units of shares of Petronas. You are actually part of the owner. It's just maybe like your ownership percentage maybe like 0.00001%. Okay, so when you buy company stock, you actually owner of the company. It's just very minority shareholder lah. Okay. Okay, next, okay, now in the equity or stocks of shares, we have 2 types, okay? We have 2 types. The one that I explain now is actually summarizing few things from the next few pages. Okay. At least you need to know the basic thing lah. Okay, so you have 2 types. One is what we call as preferred stocks or preference shares. Another one is common stocks or ordinary shares. Okay, so it's just the US and UK jargon lah. But our main text here, our main text is US books, textbook. So we are using the terms of stocks, common stocks, preferred stocks. Okay, but for the UK one, they use the term of preference shares, and this one ordinary shares. Okay. Now, for preferred stocks or preference shares, right? This one, company promised to give fixed dividend amount, same dividend amount. Confirm I will pay you the dividend. Okay, let's say you buy my stocks. This one, I'm talking about this part. Okay, so you buy the shares, okay, you buy the preferred stocks. and every year I pay you the dividend. Let's say I mentioned the dividend, I will pay you 10 ringgit per unit. So I will pay you every year. Okay? But however, company have the right to delay the dividend payment. Yeah? They have the right to delay the dividend payment lah. Yeah? Okay, that is for the preferred stock. But for preferred stocks, they don't have the right to voting. They don't have this. No voting. No voting. And they also, meaning, let's say for whatever matters, major matters for the company, right? They don't vote at all. Okay. Okay. Next one is the common stocks or the ordinary shares. Okay. So common stock or ordinary shares, usually this one they have the voting right lah. This one, common stockholder vote to elect the board of directors and other issues. So they have the voting right. Okay. And then with our voting rights, this one you will pay dividend, fixed dividend. Fixed dividend. I'll just write D. D stands for dividend. Okay. Now for common stockholder, it is not compulsory for the company to pay dividend. It is not compulsory. Okay. But once they announce that they want to pay the dividend, then they have to pay the dividend. Okay. So if I draw the priority, okay. So first, company will give priority to the bondholder. I write here. Basically, I'm summarizing the next few slides. This one bondholder. I want to write bondholder. Wait. Priority. Priority. So first, bondholder. Okay. And then second, followed by preferred stockholder. Lastly, only the common stockholder. Okay. So now, if let's say the company is about to winding up, so whatever proceeds from the sales of their assets, okay, so they have to pay whatever the coupon payment and also the par value due to the bondholder. If let's say they are about to winding up, right, and then they have to sell all their assets. Okay, the proceeds from the sale of asset, they need to pay. First, they pay internally lah. They pay whatever the staff salary, and then let's say they owe to the account payable, they have to settle that first. Okay, so the balance then they have to pay to the bondholder for the coupon payment and also the par value. Okay, and then if there's balance, only then they pay the whatever amount due for the dividend to the preferred stockholder. Okay, if there is any balance, only then they will pay whatever the amount due for the dividend for the common stockholder. Okay, so common stockholder will be the last one. Okay, and because of that, they have all other rights lah. That's why they have the rights to vote. Okay, and usually, okay, so like in Malaysia, right, corporation. Let's say like Petronas, they also owned by other corporation. Okay, like in Malaysia, in Asia countries, it's like that. The major shareholder of corporation is coming from other corporations. Okay, like all of us individual investors, okay, we only earn few percent lah. Okay, the minority percentage shareholders. So you guys actually can look at the company annual report. They have in the annual report, I think last few pages, they listed out the top 30 shareholders of their company. You guys can have a look. Some, they are maybe like in the top 5 or top 10, also include those wealthy individuals lah. Okay, so any company, they have to declare that the top 30 of the majority shareholders, okay, in the annual report. Okay, now, so remember, when it comes to the stocks, company will compensate in terms of dividend payment. This one. Okay? But remember, this one, right? Dividend are not considered as cost of doing business. Okay? It's not part of the cost of company. Dividend, if you guys could recall, midterm test, right? We have to prepare what? Income statement. The dividend you deduct from the net profit. It's not, you don't put it under the operational expenses. Okay? So that's what you mean by here, are not considered as cost of doing business and are not tax deductible. In the company point of view, okay, this dividend is not taxable. Okay? However, right, okay, and also not a liability of the company unless they declare. Meaning, let's say lah, my company is Petronas. Okay? So I already know the profit, then I announce publicly, okay, we will pay 50 cents per share this year. Then I am obligated to pay the dividend lah, okay? But if let's say I don't declare that, then it's not obligated to pay. Yeah. But usually company, right, the dividend actually attract investors. Okay. So this actually link back with the financial management goal. Okay. To increase the current share price, maximization of the current share price. Okay. So that is relate with this lah. Okay. And then usually if let's say the company is 100% equity, they don't have any debt financing, okay, that's what I mean here, usually they cannot go bankrupt. If let's say they have issues managing their cash flow, they will merge, they will sell their company to others, or they will merge with other company. Okay, so that's why here all equity firm cannot go bankrupt because they don't have any obligation like to pay the loan or to pay the coupon payment if let's say they have bond. Okay. Okay. Now for the bond here, the second point, so they don't have voting right. Okay, interest is considered as cost of doing business and tax deductible. Okay. So if you guys could recall the income statement format, right? Starting from sales minus cost of goods sold, then you have gross profit, and then you minus company operational cost, then you have the EBIT, earnings before interest and tax. EBIT, so and then you minus interest, okay, then you minus tax. Okay, so here that's what you mean here. Interest is considered as cost of doing business. Yes, you have to pay the interest here, right? Whenever you have debt financing, and it's tax deductible. Okay, it's tax deductible here. Okay, so it's different thing lah. This one dividend, this one is the interest here is the coupon payment for the bondholder lah. If let's say you have debt financing, the part of the monthly installment is the interest payment to the bank. Okay, and here creditors have legal recourse if the interest or principal payment are missed. This is the one I mentioned earlier. If let's say the company winding up, you have the right, the bondholder has the right to claim all this, the coupon payment, right, and also the par value of 1,000. Okay, and then other than that, okay, for if let's say company have bond or debt financing, right, if let's say they don't manage this one well, it can lead to financial distress and bankruptcy. Okay, so it doesn't mean that you are listed company, you are doing well. If you notice, like 7-Eleven, right? I think during topic 3, we did some ratio. They are not really making money. They're having losses. 7-Eleven. Okay. So here, company, right? They should have optimal level of debt. Okay. Some may have like this one 70% of equity and then 30% of debt. Okay. So the percentage, it depends. They have to conduct the capital structure analysis, which is not covered at your level. Yeah? But it's sufficient for you to know that if they have excess debt, it can lead to financial distress. Okay? So in Bursa, there's one part, okay, under the listing, right? They have the PN13. Okay, PN13 meaning that is the company that having financial distress or cash flow problem. Okay. Okay. Remember this one, slide number 5. How many points they ask you guys to memorize? 3, memorize. By who or by crook? This one lah. Any 3 lah, any 3. Any 3 for both. Okay, slide number 5. Yeah. Okay, this is the one that I already explained. This one is sufficient enough for you to know that you have the voting right and whatnot lah. Okay. Okay, this one done on it. Okay. Okay. Now, other than that, this actually has been discussed in the topic 1, but I just go through. Okay. So in the stock market, we have 2 types. We have primary and secondary. Okay, primary market, this is where you will see the new shares, the new stocks, okay, or what we call as IPO, initial public offering. Initial public offering, meaning the company is just newly listed in the stock exchange. Okay, so if you want to buy this type of stock, they have different platform. Okay, different platform. And then the existing shares, right, it will be traded in the secondary market. Let's say like the existing one, Petronas share, right, they have another platform lah. So this platform, this one, right, nowadays all online. Okay, last time when I used to play trading games when I was in uni. No, yeah, I don't win lah because other earn more money compared to my group. Yeah, but then you know that was back in 2001. We have last time we don't have internet. What we did every day have to buy newspaper and check the share price there every day for 14 days. You know, except for Saturday Sunday lah. The stock market close during weekend. They close. They open at 8 and 9. 9 close at 5. Soon they will close lah. Okay. So can you imagine year 2001? Have to buy newspaper, check lah which one to play, which one to buy. They give us like so-called like digital money lah, but we have to record it like manually. Okay. So this one different platform but I really encourage you guys to learn this. Okay, to learn this. And nowadays there are many classes which is it's not that costly. Don't take the few thousands class. No, don't take that. Okay, just take the normal basic classes. Okay, follow those who are those influencer have knowledge about this, like Nafisah Amran, Nafsah Amran or Nafisah Amran, I forgot. And then Dr. Adam Zubay, they have the basic classes whereby you actually can learn and play stocks. But stocks Malaysian one lah. Malaysian one. Okay. Okay. Then other than that, okay, you need to know the dealer and brokers. Okay. So dealer basically it's like the used car dealer. Okay. They are the one that they're ready to buy or sell the shares anytime. Okay, that is dealer, meaning they are ready. They have the shares. They can buy and sell. Okay. Meanwhile, broker, they don't own the shares. They don't own. Okay, but they are just the intermediaries. Okay, so this one like a real estate broker lah, like the property agent one, right? Property agent, they don't own the property. They just the intermediaries. Okay, so if you want to play stocks, you have to open CDS account, Central Depository. What the S system? I forgot. CDS account. So it's only how much? 12 ringgit. It's only 12 ringgit for you guys to open. And you have to choose lah. You have to choose which investment bank that you want to open, and you will be linked to one broker lah. You'll be linked to one broker. I don't know what happened. Okay, it's cheap. Yeah, you can invest as low as. It depends lah. Because one lot of shares is 100 unit. There are shares of 30 cents, 20 cents, got 50 cents also got 100 ringgit per share also got. Okay. What's the time now? There's a lot actually for this topic. I speed up a bit. Okay. Now, I summarize. Okay. Now, if let's say you are the investor, okay, or stockholder, your income, okay, you will concern about these two things. Okay, So first, this part. So usually, okay, you've been taught that buy low, sell high, right? Okay, when you buy at lower share price, then you can, and you expect the share price to increase, then you can sell it at higher price. So that's where you will gain the capital gain. Okay, so that is your cash flow. Okay, and another one is when the company pay you dividend. Okay, so usually the dividend, it can be cash dividend. Okay, and it also can be stock dividend. There are many type of dividend. Okay, so if let's say the company declare, okay, we declare that this year we will pay dividend of 1 ringgit per share per unit. Okay, and then it depends lah how many unit that you own. Then they will disburse directly to your account. Okay, when you subscribe, when you open your investment account with the bank, they will ask you your own personal bank account, so that whenever you receive the cash dividend, right, the company will pay directly to your account. Okay, if you get the cash dividend lah. Okay, other than that, usually they will offer you more number unit of shares. Okay, what we call as stocks dividend. Okay. Okay, now so basically, right, when you want to revalue the stocks, you are looking at the present value of the dividend. Okay, so you should have the your expectation on the future dividends. Okay, and then you discount back using the present value concept. Okay, so there are actually many determinants. There are many determinants for the stock price, but conceptually, right? Okay. So how to compute the stock price? First, you need to determine the dividend first, right? Okay, and then after you determine the dividend, then all this expected future dividend you discount back to the current current year, and then this is where you will find the present value for all of this. Okay, this is the basic thing lah. Yeah. Okay, example. Suppose you are thinking of purchasing the stock of More Oil Incorporation. Okay, you expect it to pay $2 dividend in 1 year, meaning after a year you will receive this $2 dividend. Okay, and you believe you can sell the stock for 14 at that time, meaning after a year, right, you can get 14. Okay, you sell it for 14, and then you require a return of 20% on investment of this risk. What is the maximum you would be willing to pay? Okay, so usually when you have this term, right, you are looking at the present value. Okay, so now next year you will receive this. You see, next year you will receive this, and you expect that you want to sell this. Okay, these are the cash flow that you receive after a year. Okay, so which are these two things lah? Okay, and then you find the present value. Present value formula, present value, you are calculating present value. Present value formula is the future value divide 1 plus R. Ayo, this is R. You guys look at that screen lah. I don't know what happened to this, the main one. You see, this is actually interrelated lah with the time value of money concept. But you still can survive without knowing in detail for the time value of money concept. Okay, this is what T or N. Okay, so you expect next year you will receive these two. These are your future value. Okay, then 1 plus R, 1 plus, this is your R. This is your required return. This one. Okay, so 20% lah. This one power by 1, so no need to write, right? So when you calculate this, then this stock, it worth 13.33 today. So if let's say lah, in terms of decision, right? Let's say lah, this one you are thinking of purchasing, not yet purchased. So if let's say today, I have to look, is there any investor want to sell me, the existing investor, right, want to sell me at this price or not? If let's say there are others selling at this price, then I will just grab it lah, because I know this is the worth as it today. But if let's say there are other investors selling this for 15, let's say, then you better not buying lah. Okay. But if let's say there's other investors sell this share at 12, and then you can buy. Yeah, but you know that the value as at today is this much. Okay, and actually in the real world, right, your price expectation here, they have like, because the shares number is very small, it can be up to, let's say, three digits. Okay, there's a queue. There's a queue actually of buying the shares in the system lah. Okay. Okay, next one. So same example. So what about if, let's say, okay, that stock you decide to hold for 3 years. Okay, when you decide to hold for the 3 years and you expect the dividend to be next year, D2 meaning dividend year 2. Okay, this one dividend year 1. CF1 meaning cash flow. Okay, so meaning cash flow as in year 1, you will receive dividend $2. As in year 2, you will receive dividend 2.10. So your cash flow 2 is 2.10 lah. Okay, and then you expect in the year 3, you will receive dividend of 2.205. And then you expect you want to sell it. P stand for price. You need to know all this. D dividend. P price. Very important for this one. If not, then you may unable to do the calculation. Okay. P stand for price. Okay. So you are assuming if you hold these shares and you want to sell it at year 3 for this much, right? Okay, so these are the cash flow. CF stand for cash flow. These are the cash flow during year 3. So you plus. So cash flow year 3, you have 17.640, right? And then you find the present value for all of this. These are the present value, all this. Okay, so this is 1 plus R. The R just now is 20%. This is for cash flow year 1. This is cash flow 2. You receive dividend. And these are the year 3. From the dividend year 1, dividend year 3 and also the selling price. Okay, so when you solve this, it's still the same. Okay, meaning in the next 3 years, right, if you expect this cash flow, you also, the value of the stocks is 13.33. Yeah, usually this one involved with decision making lah. Other than that, okay, so that is the basic one. The basic one, how you calculate or how you value the stocks. Okay, but we have a lot more calculation other than this. Okay, now first you need to know how to estimate your dividend. There are many ways. Yeah, so one way is constant dividend or zero growth. Okay, now dividend. Usually before you calculate the price, you have to determine the dividend. Okay, so the first one is constant dividend or zero growth, meaning this is like the preferred stock. Okay, preferred stock, the dividend is fixed. Okay, the dividend will be always the same throughout the period. If let's say they declare when you purchase preferred stock, they say, okay, this stock, preferred stock, I will pay $2 for 1 unit of share. So until forever lah, unless they declare, oh, we want to increase it or we want to decrease it. Okay, so that is what we call as constant or zero growth dividend. Okay. Okay, next one, constant dividend growth. When a constant dividend, there's one dividend, one is growth. There are two different things. There are two different things. Okay, now here dividend growth. Dividend growth meaning dividend increment. There's an increment in the dividend. Increment. Increment in the dividend. Alright, short form. Okay, now, so this is another method. Okay, sometimes company, they mention that, okay, the dividend will increase by 5% every year for the next 5 years or for forever. Okay, it's not fixed. Okay, like this one they mentioned, it's not going to be increased, it will be the same value. This one, the dividend will increase in the certain percentage. Okay, if you guys confused this one, right, you just memorize it like, let's say you work, then you have salary increment. So salary increment like this one. Okay, and the other one is supernormal growth. Supernormal growth, usually the dividend pattern here, it's not consistent. It may change over the time. Okay, maybe like let's say lah, my company is just newly listed in the stocks exchange. So because I just, newly listed, my capital is not that strong. So I'm afraid that I have very limited profit. Then I don't want to pay dividend. Then maybe the first few years I only practice this for the first 5 years, and then maybe after 5 years, year 6 onward, then I use this method. Okay, so basically supernormal growth here, they have a mixture of this, yeah, and sometimes after they're already stable, so the percentage here they increase by more lah compared to the previous one. Okay. Okay, now for the zero growth stocks or for all preferred stock, we will use this formula. Okay, preferred stock. We will use this formula. Okay, this is actually perpetuity formula, relate back with the discounted cash flow valuation topic 6. Okay, because they have been promised fixed dividend amount, so therefore we use this formula, fixed dividend. Okay, so how to calculate is just P equal to D divided by R. D stand for dividend, R is the required return. Just divide it, then you will get the value lah. Okay, so example like this one. Suppose a stock is expected to pay 50-cent dividend, okay, every quarter. But this one quarterly basis lah. And required return is 10% with quarterly compounding. What is the price of these stocks? Okay, so you just use this formula, the dividend, okay. But then here, the return is 10% compounding quarterly, right? So then here, that's why the 10% divided by 4 lah. Okay, if let's say the required return compounding annually, then no need to divide by 4. You just directly divide 50 cents with the 10%. Okay. So for this preferred stock, okay, when you solve this, it is actually worth 20 today. Okay. But very rare lah, I do like this. Usually I just give this one quite direct lah, because this one compounding, quarterly compounding. Okay. If without the quarterly, just divide with the 10%. Okay. That is for preferred stock. This one. Okay. Next one. This one involves a lot of maths. Okay. Now, the second method is constant growth stocks. Okay. Whereby the dividend will increase by certain percentage every year. This is the increment just now. Okay. You will increase by certain percentage every year. Increment on the dividend. Okay. Okay, now these are the formula. I also paste this in the formula booklet. This one. This and this only. Okay, now D1, D stand for dividend. D1 meaning next year dividend. Next year dividend equal to D0 is current or last year dividend. Or dividend just paid lah. Current, it depends. It depends. Current or last year dividend. Ayo. Okay, D0. I'm talking about D0. So D1 is next year dividend. Usually in my question, it's either I give you D1 or D0. Only this. It's either one. So you have to look at my statement. If I mention current, last year, or just paid dividend, meaning that is D0. If let's say I mention next year dividend, then it will be D1. Okay, remember this, but you please be very careful for this part, because this will determine the whole calculation. Okay. Now basically, next year dividend, right, is coming from the last year or the current dividend multiplied with 1 plus G. Okay, G is stand for growth rate or dividend rate. Dividend rate, growth rate. Okay, dividend rate or growth rate. So, and then you power back by 1. Actually, this is the future value formula. This is actually future value formula. Okay. So if let's say you are calculating the dividend as in year 3, okay, you take from the current or last year dividend, multiply 1 plus the growth rate, power back by 2. You see? Dividend year 2, power by 2. But provided that this is the D0 lah. Okay? So because of this, then we summarize the formula to this one. This T or N is the same. If let's say you want to find dividend as in year 10, so this one you power by 10. If let's say you want to find dividend as in year 20, right? Provided that you have the D0, then this one you power by year 20. Power by 20. Okay? You need to understand the formula. Then only you know. But I give you guys like situation, and I give you information is either this or this. Then I will mention calculate expected future dividend in the next 30 years. Then you determine the D0, 1 plus G will be given, power by 30. Okay? So based on that, right, if let's say we have been given this information, okay, let me finish a few slides more. We take a break in 5 minutes, okay. Now let's say we've been given the current dividend, which is $2, and then the growth rate will increase by 6% every year. Okay? So if you want to calculate the next year dividend, it's coming from the D0 multiply 1 plus 6%. Okay? There are a few methods for you to calculate the expected future dividend. It's either you use this formula, or you can calculate manually one by one like this. Okay, that's why I said this is like basic maths. This is basic maths. I have students, they calculate manually logically, based on the concept here. Okay. So the first dividend, okay, after 1 year it will increase by 6%. Therefore, dividend as in year 1 will be 2.12. Okay. So then next year accumulate another 6%. See, next year, right, you accumulate another 6%. Okay. If you want to follow the formula just now, for this one, you can do like this as well. Okay, if let's say year 2, right, then power by 2. But this one must be D0. This one must be D0. This is another alternative like the previous formula one. Okay. So then the next year you add another 6%. Next year you add another 6%. Okay. So if let's say you want to use the previous formula, you see this one is using the previous, we just add another 6%. Okay. Alternatively, for this one, okay, you also can do like the previous one D0 multiply 1 plus G power by 3. Okay. You will get the same answer. You will get the same answer. And now this one, don't forget you must give me up to 2 decimal places, round up the figures. Okay, round up the figures. Yeah. So in this topic, you need to know dividend first. Only then you know how to calculate the price. Okay. I explain about the formula first. So dividend settle. Dividend, it's either you want to use the formula like this, or you just use based on logic. Okay, you calculate manually one by one. All this data will be given. Okay. Okay. Now, other than the present value formula just now, we also have another method, what we call as Gordon growth model. Okay. This is to determine the current share price. Okay. P stands for price. Current share price. We'll be using a lot this formula and also the previous one. Current share price. Share price, current stock price. Okay, now you have 2 formula here for you to calculate the share price. Okay, under this dividend growth model, there are a few assumptions. Okay, but I will just summarize it You guys can have a look at other online sources. Okay, so for that is actually this formula created by this Professor Gordon. Okay, but under certain a few assumptions, whereby one of it is the required return will always be more than the G. Okay, you can only use this formula if your required return is more than the G. Okay, it cannot be more than that. If let's say it's more, then you cannot use this. Okay, this is based on the Professor Gordon research lah. Yeah. Okay, now you have two formula. The first part here, you will use this one if you have been given current or last year dividend. Okay, if let's say the question give you next year dividend, then you use this one. It's either one. It's either one. Yeah, I just paste this in the formula booklet. Yeah, so you have to refer back to the question whether I give you D0 or D1. If I give you D0, then use this. If let's say I give you D1, then you use this one. Okay? Okay, we take a break. Then after this, we will continue with the examples of the dividend growth model. This one important. Dividend calculation. This, mana here? This one, and the rest lah. And the rest. It's quite heavy topic lah. We take a break for 10 minutes. Then after this, we will continue with the remaining 28 slides. 28 slides. There's many more. My time is 5, so 5:10. Please come back at 5:10. Okay, guys, let's continue. Where did we stop just now? Can you help me switch off one of the aircon? Is it raining outside? No. Then you switch off one of the aircon lah. But I think that one is off already, I think. Try to reduce the temperature. Can? Or maybe like the fan. It's a bit cold actually. I thought raining outside. Okay. Now let's look at the example. We'll be using a lot this formula and also the dividend just now. Okay, let's look at the example 1. Okay, suppose Big D Incorporation just paid a dividend of 50 cents. This one. This is actually from the author slides, so I don't amend. I only amend a few things. 0.5, if you guys can see there lah, it's already 0.05. Okay. So, wait. A dividend of 50 cents, okay? Now, this dividend information I will give, but you have to look whether is a D1 or D0, okay? So like this one is just paid, what else the other term? Maybe like other than current dividend or last year dividend, then this automatically will be your D0. Okay, if let's say I mention this, suppose Big D Incorporation considering to pay dividend of 50 cents next year, then will be D1. Okay, it's either D1 or D0. Okay, so after that, right, okay, it is expected to increase its dividend by 2% per year. Okay, the dividend increment, this is what we call as the growth rate lah. This is the G. Okay, this is the G. Okay, and then if the market requires return of 15%, this is the R. Okay, on asset of this risk, how much should the stock be selling for? Okay, how much the stock be selling for? Basically, you have to calculate the current share price. Okay, so now, as in the formula just now, right? Okay, I mentioned if let's say they give you D0, then you use this one. Okay, so like this one, the just paid here is the D0. Therefore, you use this formula. Okay, which P stand for price, current share price, P0, current share price, equal to D0, dividend just paid, multiply 1 plus the growth rate here, which is 2%. This is 50 cents from here. Okay, divide with the required return here, minus back with the 2%. Don't know what happened. Hopefully the Panopto one all good. Okay, you guys look at the screen lah. So the 15%, right? This is the R, 15%. This is the R minus with the 2%. Okay, so then you solve the equation. Okay, so when you solve this, then the current share price as at today is 3.92. Okay, so if let's say lah, they ask you to make decision, if let's say other investor offer you to sell for $5, then don't buy because the investor sell it at higher price. It's overvalued. If let's say another investor offer you $3, then you buy because it's undervalued. They offer much cheaper lah than the actual current share price. Okay. Okay, that is for the first example. DGM stand for dividend growth model or the Gordon growth model. Okay. Okay, next one, example number 2. Suppose TB Pirates Incorporation is expected to pay a $2 dividend in 1 year. See, this one, $2 in 1 year. Okay, meaning next year. Okay, therefore this $2 is D1. Okay, so when you have D1, then you use this. No need to multiply with 1 plus G. Okay, so this actually reflect back lah from the formula just now here. Since you've been given D1, then you use this. It's either one. I have students still confused about this one. So it depends. If you get D0, then you use this one. If let's say you get D1, then you use this one. Okay. So since this is D1, okay, so you sub the info, okay, and then if the dividend is expected to grow at 5%, okay, so this is the G, and then the required return is 20%, okay. Basically, like in this question, you will see two percentage. One is the required return, and another one is the dividend increment rate, okay, the G lah, yeah. So and then you sub, this is the $2, this is the 20%, this is the R, 20%, this is 5%. Okay? You minus and then $2 divide, then you will get 13.33. So here, meaning, right, this price, the share price for this company is worth 13.33 today. Okay? Again, decision making, if let's say other investor offer you 15, don't buy. If others offer you this price or lower, then you buy. Okay, because it's much more cheaper. Okay. Okay, this is just FYI. So usually the stock price, they have positive relationship with the dividend increment rate. This is just FYI only, okay? But however, the stock price, they have negative relationship with the required return, okay? If you have higher required return, then usually the stock price will be much lower. Negative relationship. This is positive relationship. Stock price with the dividend growth rate. Okay, now let's look at the other example. Okay, so company example 3, success company. Okay, success. This one we have a few sub question lah. 1, 2. Okay. All these, the calculation that I mentioned starting from the example 1 are important. Okay. Okay, so example 3. Success company is expected to pay dividend of $4 next period. Okay. So what is this? D1 or D0? D1 next period, right? So meaning next year. Okay. And the dividend are expected to grow at 6%. So this is your G. And then the required return is 16%, R. Okay, remember the R will always be more than the G, only then you can use this formula. If let's say the R is less than the G, you cannot use this formula. You have to use normal present value formula. Okay. Okay. So since you have been given as D1, then you use this lah. Okay. So P0 current share price equal to, you just take the $4 here, divide with this one 16% R minus with the 6%. Okay, this one. So you solve, then you get 40. Okay, so the current share price for success company is 40. Okay, so you have, if you want to purchase, it must be the same or below than 40. Okay. Now next one, example number 3. B, just now A, they ask you to calculate current share price. Now B, what is the stock price expected to be in year 4? Okay. Price, we are not talking about dividend. Wait, pen. Okay. Price in year 4. Price meaning P. So you are asking about P4. Okay. Now there's another formula from the dividend growth model just now. Okay. There is this formula for calculating expected future share price. Okay. So Pn, P stand for the price, equal to Dn plus 1 divide with the R minus G. Okay. Now, meaning here, like this question, they ask you to find expected future share price in the next 4 years. Okay. So therefore, for this one, right, if you want to calculate the share price in year 4, the dividend must be from year 5. I write here, this is for this. So if let's say P4, then the dividend coming from year 5. That's why you have, there's a plus n plus 1 there. Okay, the n plus 1 is not like dividend plus 1%, no. Okay, so if let's say lah, you want to find share price as at year 10, then the dividend coming from what year? Next year. Let's say you want to calculate share price year 10, dividend coming from 11 lah. If let's say you want to calculate share price as in year 20, dividend from year 21. That's what it meant here, n plus 1. Actually, this topic is not that difficult, but you have to understand each of this item. Yeah, I know. See, listen to me. I don't know lah. I don't touch anything. I don't want to switch off and restart. Give. Die lah if I don't give formula. I also will cry if my lecturer don't give me formula. Tak ada lagi. If I give formula, I also when I was student also my lecturer give me formula. Without the formula, you're not professors. I also, my CPU here, RAM here not that high. Okay, but here because I taught many years, then I memorized the formula. Okay, so this one you must know. Okay, so if let's say you want to find the price, share price, it must be additional 1 year. Okay, let's say price as in year 40, then dividend coming from year 41. Okay, let's say share price 15, dividend coming from year 16. Okay, so actually there are few ways. So this is the first method lah. This is the first method for you to calculate. Okay, now method 1, okay, so it's coming from the dividend at year 5, right? R minus G. Then you have to find the dividend as in year 5. Okay, so like in this question, because they give you just now is the next year dividend. This next year dividend, right? This is D1. Therefore, right, in order to increase the dividend up to year 5 here, because this is already year 1, then you power by 4. Okay, then you will get the dividend lah. Yeah, so the D1, which is $4 here, multiply 1 plus 6% here, and then power by 4. So then you will get the dividend as in year 5. Okay, and then you just take the 16% here, okay, minus with the 6% growth rate. Okay, therefore, for the share price, as in year 4, you expect it to increase by 50.50. Okay, so this is the first method lah. Same method. Okay, this is the other method, but a pretty quite long method lah. Okay, the first one, still same question. Okay, for the method 2, first, right, because you have been given D1, right, you have been given next year dividend here, this part, this one. Therefore, what you need to do, you have to determine the current or last year dividend, meaning you determine the D0 first. Okay? So, coming from the D1, this formula also attached. So, D1 equal to D0 times 1 plus G. So, you sub all the info first. Your motive now, you want to find this. Okay? So, you rearrange after you sub the info, right? So basically you will divide lah. Okay, so D1 $4 divide with 1 plus the G 6%, then you will get D0 of 3.77. Okay, so this is the first step. So after that, only you calculate the dividend as in year 5. Okay, you use this formula. This is dividend, D stand for dividend. So now, because this is year 5, so you just power by 5. Provided that you already determine the current or last year dividend D0. If let's say you want to find dividend as in year 10, then the D0 here power by 10. If let's say you want to find dividend as in year 20, then the D0 multiply 1 plus the interest rate power by 20. Okay? So based on this one, right, so you take the current dividend just now, 3.77, multiply 1 plus 6% the growth rate here, then the dividend as in year 5 will be 5.05. Okay? So here, right, you will get very small number, just round out to 2 decimal places. Okay, just round out to decimal places. Okay? I also have students calculate the dividend based on logic. Yeah, really. If you understand, because basically the G is the increment, normal increment on yearly basis. That's why I provided 2 methods here. This one, you have to understand this mathematically. For dividend lah, for dividend. Okay, now, so after you calculate the dividend as in year 5, only then you sub this info to this. Okay, 5.05 divide the R minus G. Okay, usually the R minus G, it won't change lah. Okay, 16% minus 6, then you will get the same answer, which is 50.50. Okay, so usually I use this one rather than this one. When I use this one, students get confused. It looks simple, but then you have, if you have strong basic maths, you can do like this lah. Okay. So usually I use this method lah. I leave it to you. Okay. So all this important. You need to know how to calculate dividend, and as I mentioned, I will give you either D1 or D0. D1 meaning next year, or D0 is current or current, last year, or just paid dividend. Okay. So usually you have to calculate the expected future dividend, and then you have to calculate current share price. Okay, and then you also have to calculate expected future share price. Okay, like this. Okay, so these are among the assumptions just now. Okay, for the formula of the dividend growth model. Okay, you need to know this part only lah. Okay, if let's say lah in the question you notice the R here is less than the 6%, you cannot use this. You cannot use this formula at all, but very rare lah. Okay. Usually the R will always be more than the G. Why got test understanding here? Got enough time? 5:30. Can lah, Okay, what is the stock? What is the value of a stock that is expected to pay a constant dividend of $2 per year if the required return is 15%? Okay, so this one mentioned about constant dividend. The other name for constant is fixed, right? Fixed dividend. Okay? As you can see here, there is no dividend growth. Okay? This is actually the preferred stock. Okay? Preferred stock, okay, how you calculate is only based on this share price, dividend divide with the R. Okay? You guys calculate for me. So this $2 just divide with the 15%. That is the current share price for these stocks. How much, guys, this one? 0.3. Bukan 30, bukan 3. Ni kan percent, this one. Ni divide 13.3. 13.3. Oh, same lah like the previous one. Ni, like this. Okay. This one because the keyword is constant dividend. Okay. And some more, if you want to use the previous formula, you don't have the dividend growth rate. You don't have the G. Okay. Okay. Next one. What if the company starts increasing dividend by 3% per year, beginning with the next dividend? Okay. See, next dividend. Okay. Now they want to increase this. Right. Next dividend increased by 3%. Okay. So this, what if the company says, okay, now required return is 15%. Okay. So basically here, you need to calculate the current share price. Okay, you need to calculate the current share price. But then now, your dividend increase. Okay. So the $2 just now is the current dividend D0. Okay. And then they want to increase it by 3%. Okay. So now if you want to calculate the price, stock price, so this is the R, this is the R. So you can use D0 times 1 plus G. Ayo. Okay, so this one D0, right? $2. I don't have enough space to write. Can I just type? I type lah. Where is it? Oh, you have gone already. Oh, cannot. I copy and paste lah. One more here. This is for this one, So P0 equal to D0 times 1 plus G. Okay? And then divide with R. R minus G. Okay, so just do like this. So this is $2. You can calculate for me. 1 plus 3%. So then this, the R is 15% minus with the 3%. Like this. Calculate for me, please. How much you get for this one? 17.1717. Apa ni? What is this? Oh. Okay. Okay, so this is how you calculate for the share price lah. Like just now, this part. Why the question gone? This one, before this you don't pay the, you don't have the dividend increment. Okay, then the next part, the next question whereby you increase the dividend next year by 3%. Okay. So then this share is valued at 17.17. Okay, if other investor offer you more than this, you don't buy. If let's say less than this or same, then you will buy the shares. Okay. Okay, one more. Many. All this important. Okay. Now, if let's say you have been given all the information except for the required return, okay. Therefore, you have to use this formula lah. Okay, it's the same thing. Yeah, from the one that we actually from the previous formula, same, okay? But then you have been given the current share price, the dividend, growth rate, but you need to determine the R here, okay? So example 4, a firm's stocks is selling for 10.50. Okay, they just paid $1 dividend. Okay, just paid $1 dividend. Then this is D0. Okay, and the dividend is expected to grow at 5%. So this is the G. And then the question asks you, what is the required return? What is the R? Okay, so you can use from this formula, this one. Okay, but you have to rearrange. Okay, alternatively, you also have this to simplify. Okay, so if let's say I give you D0, you use this part until here. If let's say I give you D1, then you use this one. There are two parts here. Separate question. So this one for the D0, meaning for this question, we use this one. If let's say for other question, let's say they provide you D1, then you use this. This is for D1. Okay? So since you've been given with D0, so $1 multiply 1 plus 5% here for the growth rate, divide with the price, and don't forget to plus back with the G here 5%. Okay? So when you solve this, then we get 15%. Okay? So that is the required return for this question. Okay. Okay, so done for the calculation part. So please make sure you know how to do this. The question is more or less similar. Even the tutorial also like this. Yeah. Okay. Now last one for the dividend. This is just FYI. I just verbally explain. Okay. You guys can have a look. Okay. So now, as I mentioned, it's not compulsory for company to pay dividend. Okay, but those companies who pay dividend, they have this policy. Yeah, so they have choices whereby they will pay cash dividend. Okay, so cash dividend, then they will directly bank in the money to your account. Okay, and then other than that, okay, they also will offer stocks. Okay, so other than that, okay, these are the stocks dividend, meaning, let's say lah, at the moment when you purchase the company share, you purchase 2 lot. 2 lot meaning 200 units of shares. So now, because they declare stock dividend, they give you, let's say for 1 unit, they give you extra another 1 unit. So your number of unit of shares will increase lah. That is for the stocks dividend. Okay. And then other than that, stock split here. These two method, right? Okay, company also sometimes they will buy back their own shares. Okay, sometimes they will buy back their own shares from the investor. Okay, there are many reasons. One way of it because they want to protect the current share price, and also they want to have the larger. Basically, actually because of the share price lah. That one they does have effect lah, yeah, when they buy back their own shares. Okay. Other than that, stock split here meaning for 1 unit of shares they will split it into 2. Some shares 2 unit become 1 shares. Okay, they have few methods here. 1 share become 2, 2 shares become 1 share. Okay, sometimes they want to reduce the number of unit of shares in the market because they want to effect on the current share price. Okay, so that's roughly about these two lah. So I just verbally explain, so the rest you guys can have a look lah for your information. Okay, there are many lah. Stock repurchase. Okay, just can have a look. And don't forget, before that, okay, there are pros and cons in terms of paying dividend. But as an investor, usually we prefer to have dividend lah, because that one will increase your number of unit of shares that you own, or in other words, your ownership. Okay, but however, all of this will give impact lah to the company. Oh, tak sabar-sabarnya nak habis you all ni. Okay, so this is the same formula that I attached together with the rest just now. Okay, So please guys, I don't want you guys to skip my classes until week 14. Those who came in late, next week will be our last lecture. But tutorial will be held as usual until week 14. Okay? Because we, tutorial will be one topic late, right? This one what counts? Okay, you make it in your attendance now. So please manage your time well. Okay, give me some time to mark your group assignment. Hopefully by next week I manage to complete it lah. Okay, thank you. I'll see you guys next week. But some of you I will be meeting you guys tomorrow. Xia Yong Hang here or not? No, right? Hey, Shah left already. I want this one faster.
There you go. Thank you.
Okay lah, every six you get this much, and then plus with the group assignment.
So this is what pass already, is it?
Pass lah. Thank you. Okay, welcome. Ya. Siapa Dr. Sungjit? Tadi kan you hantar. Siapa hantar tadi? Syasha. Garang. Dia TU lecturer lah. It's okay, can. Don't worry. I don't think they check. Mana tadi Jared? Bye-bye. So handsome one today. You guys lah. Kenapa lah this one? Kan clash I ada kelas. I besok I tak kenal diorang. I kalau jadi judge I memang garang.
Miss, you tahu tak kita orang the only one yang pakai kebaya?
Yelah tu lah cantik. Dia siapa? Pranav.
Instead of pakai ni.
Cantik. Itulah tadi diorang cakap, takut nanti mesti ingat nanti. Tak, I sekarang ni I macam like, is it only me that not in the loop? I tak tahu pula yang Miss Umi tak